We will look at stocks on a 4-hour chart, and I think they're still in a downtrend with another sell signal recently happening. Bears are predominating right now, but this could mean a rally soon. We will look at the put-call ratio and see what it is showing us. Utilities are still leading the stock market, and this could be viewed from two perspectives. One is this is a defensive play, and the other one is that there are lower interest rates ahead and general stock market will also join in. Technically speaking, stocks are not yet oversold, although some sectors are, and I will give you several examples of those. We will dive deep into Forex overview. This week we will cover Euro, Yen, British Pound, Canadian and New Zealand dollar. All of these are either already in a downtrend versus the US dollar or about to enter it. And we will look at precious metals, which are being hit by a stronger and stronger dollar. Finally, we will look at oil, which could easily climb to 130 or possibly higher. All this and more in today's edition of MasterChartsTrading.com market recap for Friday, April 3rd, 2026. As always, please don't forget to hit the like button, share this video, make a comment, even put a thumbs up in the comment section or any kind of comment, hopefully positive. Thank you for all the good positive comments. Thank you, and please keep them coming. This is helping the video get more views. If you're a subscriber, stay tuned. There's going to be quite a busy video because there's a lot of stocks that are already somewhat or deeply oversold. You can see there's a lot of ETFs, especially, and then there are some foreign ETFs, some large cap stocks, and a few of the new speculative securities, although those are a little bit of a secondary position right now because of the market uncertainty. We will, throughout the presentation, use my proprietary MasterChartsTrading.com price action indicators, for which you can sign up by going to my site, MasterChartsTrading.com. You can see those indicators on this site, on this chart, this green, blue, red, and yellow lines. These lines are available for this interface, TradingView.com. TradingView.com is a free interface, and you can have the same lines on your chart. We're currently looking at S&P 500, and I said that technically speaking, stocks are not yet even oversold, although some sectors are. And so what does that mean? So if we look at my lines, when I say stocks are oversold, they need to be at least touching the blue line. So for example, the previous instance of when the stocks were indeed at least somewhat oversold was back in March of 2025. Notice that we touched this blue support resistance line, we collapsed below it, but eventually rallied above it. So this was a bullish signal right here on 2nd of May 2025, and we had a pretty strong rally afterwards. Technically speaking, once again, we're not yet oversold because we haven't gotten to the blue support resistance line. I can show you one sector, or at least a index, which is indeed oversold, and this is Dow Jones Industrial Average. So again, how do I know? Same general principle. When the stock drops below the blue support resistance line, again, these lines are based on price action. They are not based on any kind of averages. So again, you can have them on any chart. So this is the latest opportunity, or rather the latest opportunity, to buy back in last year was in May of 2025 or so, maybe even as late as June of 2025. And currently we are there. So we are seeing that exact same pattern where the stock comes down towards the blue support resistance line, makes a low below it, and then rallies above it. So this is already a signal. So Dow Jones has been, technically speaking, oversold and now gave us a bullish signal. Now I tend to like seeing more S&P 500 because it's a broader index. And again, I'm showing you this because these lines are not yet, we haven't yet touched the blue line. So we can actually project this into the future, and you can see that we are going to have these lines projected to move higher. So two ways to look at it. One is a positive case and the other one is negative case. So a negative case would be, because notice that this yellow support resistance line, which means a bear market. So we see a bear market I wrote here. So if we close below this yellow support resistance line, and from today's prices that's around 21% drop, that would be a new bear market. However, if we just simply trade sideways more or less, or maybe slightly down, then as early as June of this year, we continue down, we will be hitting the yellow support resistance line, which would imply a new bear market. So what I'm seeing here is what's called a narrowing of a trading range. So you can see that currently the distance between the green and the yellow lines, we can measure this distance. It's about 1,400 points. Okay. But even a few, days later from today's price action. So, for example, the maximum narrowness would come, a little bit later in June. But even right here on the 8th of, around May, that narrowing would be very significant. It will be only 800 points or 11% distance between the two lines. So notice back here or currently our trading range is around 20%. So as early as, very soon, in fact, you can see that even a few days from today, the narrowing will begin. Already on April 9th, that narrowed to 18%. On April 23rd, then the trading range would narrow to 14%. On April 29th to 12%. On May 7th to 10%, etc. So this is showing me that we're seeing a very strong potential for a trend change. In this case, right this instant, the trend is still up because, like I just described, we were waiting for a touch of the blue support resistance line and a rally above it, just like we did back here in last year. But as I just showed you, because of the narrowing of the trading range, this yellow support resistance line, which means a bear market, is coming closer and closer to the price action, making it very easy for the price to close in the bear market. So we're seeing a very, very difficult situation that is actually very close, only a few weeks to a few months. So this situation could come to a head very quickly, and it would imply that we need to switch our thinking. So right now we're thinking about buying, but what if we collapse and close below the yellow line? We then will need to think about shorting or selling, and that's an entirely different perspective. Not hard, and we do it also, but that also would imply that things are just not going great at all. And if you listen to the news, I am still trying to find any sliver of good hope here or good news currently. So things are really deteriorating. We can look for who is at fault, but the general sense is that the security situation worldwide is deteriorating quickly, and what we had back, during previous administrations, perhaps, was called a Pax Americana, is basically no longer around. And so we're seeing a breakdown of alliances, we're seeing heightened insecurity, shortages, etc. So right now we're entering this unstable period in our world history, and as the pandemic has shown us, and there's this beaten to death phrase, we're all in this together. Yes, indeed. Right now, actually for a long time, the economy has been global for many years, and the supply chains are global. So, and a reduction of supply in one place would lead to huge cascades and sometimes catastrophic changes to the lives of various people. And like I keep saying, I actually, at the very beginning of this war, I already said that places like Bangladesh, Philippines, Africa, some places in Far East, etc., they are very vulnerable to this. Populations are sometimes, like in India, there are people who get enough food for a day, and if they don't get that food, they will just starve. There's nothing else for them. So these people will most likely be priced out of food because the gas prices gone up, fertilizers prices will go up. Some people will not be able to afford food, so famine, disease is definitely an option worldwide right now. And like I keep saying, yes, right now the more developed economies are absorbing the shock, but how long can this continue and will it continue? That's a different story. So very, very difficult situation, and the chart is showing this. You notice this again, this narrowing of the trading range. This is a serious situation, and it's making it super easy to get into a bear market. We're very close. When we get to the dollar, I'll explain the same thinking, because there was the same thing that happened. We had a narrowing of the trading range and a dollar breakout, followed by pressure on gold and gold miners and silver. Okay, so another stock that is quote-unquote oversold, for example. I'm giving you just a few examples here so that you know how to kind of think about trading stocks. So for example, this is Magnificent 7, and it just gave us a buy signal. Do I want to take this buy signal? Well, I am reluctant to take this buy signal. Notice again here, same thing. Notice the way the indicator lines are narrowing together. So if right this instant the distance between the two lines, the green and the yellow, is 31% or 19 points, then just a few weeks later this distance would be much smaller. This distance would be only 16%. So literally it would half in June, and not even and in May it would almost be basically half of the previous trading range. So this is again showing that we're in a significant danger of entering a bear market. It hasn't happened yet, but there is danger of that. Positives. So here's one positive, XLU, utilities. So utilities are sensitive to the interest rates, and usually they rally before the interest rates drop. And so right now utilities are actually trading next to records, while other stock sectors, like for example consumer discretionary, have pulled back significantly. So utilities trading next to records imply that most likely interest rates will come down. And lower interest rates in general is good for the stock market. So what we're seeing here is a possibility of lower interest rates and stock market avoiding this pretty catastrophic scenario that I'm describing here, where the trading range narrows, we break below the yellow line, maybe we have a small rally, but then we see an actual bear market, as when we did in 2000 or 2007, 8, 9, whatever. So not a very good situation at all. We will play it by ear as always, but just like heads up, you may want to consider avoiding large swings in your positions and just keep more cash on hand. That's what I've been doing. Some of my positions got stopped out, some at profit, actually many at profit, and I'm just not really trading as much right now stocks. All right, let me know if that makes sense. Make a comment and let me know your thoughts about the direction of the stock market. And let's look at the dollar now. So first of all, let's look at the actual dollar currency index. And here's what I wanted to show you, a very similar scenario. So back, for example, here in January of this year, notice the distance between these two, the green and the yellow lines, was 9%, very large distance. But then notice how the indicators got closer and closer together, and actually right now they're very close. They're only 4% apart. So this is what I again call narrowing of a trading range. And during those narrowing of a trading range, very often the trading direction changes hands. So whereas dollar was in a downtrend up till recently, when we saw a breakout above the blue support resistance line where I'm hovering right now on 30th of March of this year, it happened during this very tight and trading range where notice how close the yellow line and the red line and blue line are to each other and how far apart they were just a few months ago here in December and January. So right now the dollar has broken out into a new bull market. So now the dollar will most likely start making higher highs and higher lows and continue higher. It will imply weighing on various gold and gold miners and silver, which we'll get to in a second. But let's first look at the individual currencies that make up the US dollar index. Number one is euro versus US dollar. So again, a euro divided by US dollar. So US dollar is on the bottom and it's getting bigger. So it will pull this currency pair lower. Technically speaking, euro hasn't actually yet broken down. Notice on March 30th and March 31st right here, we touched the red support resistance line, but not yet. We haven't yet broken below it. So we were very close, but we rallied just above it. I think we will break it. I think it's very, very unlikely that euro will stay in the uptrend versus other currencies which are already in a downtrend against the dollar. So for example, here's one that has been in a downtrend against the dollar for a while, and it is US dollar versus Japanese yen. Here the thinking is reversed. US dollar is on the top and it's getting bigger, so it's pulling this currency pair up. And this actually started back in October of last year. Notice this breakout right here where I'm hovering, 7th of October of 2025. It broke above the blue support resistance line, and then we had actually several opportunities to buy this currency pair, potentially there. And now we are actually next to multi-decade lows for the Japanese yen, or multi-decade highs for this currency pair. So US dollar versus Japanese yen definitely is now in an uptrend in favor of US dollar. Recent developments in the Forex markets. Here's British pound divided by US dollar. So again, US dollar here is on the bottom, so it's pulling this currency pair lower. And notice that it just broke out, or broke down rather, into a new bear market for the British pound by closing below this red support resistance line. There was actually a retest right there, and so far the bear market is holding for the British pound. US dollar versus Canadian dollar, we've seen the same situation. Notice that again the trading range narrowed. Back here in January, trading range was like 5%, but now it's very tight. It's only 3%, and now we're seeing a breakout. So it took less energy for the stock to move towards the bullish levels, and now we are in a bull market. US dollar on top, Canadian dollar on the bottom. US dollar is pulling this currency pair higher in favor of US dollar also. And finally, New Zealand dollar also just recently broke down. There it is. The breakdown occurred just a few days ago on 27th of March. And notice we're moving lower in favor of US dollar because this is a currency pair where New Zealand dollar is on top, US dollar on the bottom. US dollar is getting bigger, pulling this currency pair lower. So to summarize, dollar is composed of several currencies. Dollar currency index composed of several currencies: euro, US dollar, Japanese yen, Canadian dollar, Swiss franc, New Zealand, Australian dollar. And notice that again, dollar is in an uptrend now, so we need to think about it as bullish. By extension, gold has been under pressure as dollar has rallied. Gold topped out here around 29th of January and pretty much has been making lower lows. Now we're seeing a buy signal yesterday on April 1st, but once again I'm not certain I want to take the signal because dollar is in an uptrend, and this currency pair is gold divided by US dollar. So again, US dollar is getting bigger. It should pull this currency pair lower, which means lower gold prices ahead. So I am not exactly sure if I want to buy gold at this point. Gold miners seem a little bit stronger. They are more volatile, although they also came down quite a bit. Technically speaking, once again, they just gave us a buy signal. I did not want to take it right now, again, because of the way dollar is behaving. Dollar is getting stronger. Gold miners are, miners of gold, so they will most likely come under pressure as well. So same goes for silver. We're seeing silver under even stronger pressure. In fact, we just toyed with bearish levels on 23rd of March here. We actually dropped into this territory, but so far have been able to hold that support. I think, again, it's the same thing as silver divided by US dollars. So if the US dollar is getting bigger, it will only make sense that this currency pair will continue lower. Okay, let's finish up with oil. So, as I mentioned in the beginning, oil prices are increasing dramatically. This is weighing on especially developing countries, emerging markets. There is already rationing in many places. So this will propagate through the economy, and bad things will happen basically. Apart from insecurity, there's also economic damage, so we're seeing that already. As far as oil is concerned, so on this chart, if I knew nothing of nothing, like on this chart you cannot tell that the war broke out, right? You just can see the price of oil spike. And notice here that we had basically 2 days to get in at very low price, 2nd of March and 3rd of March, when pretty much everybody was just still in a shock from what just happened, and war hasn't yet been normalized. I mean, this normalization is already happening, unfortunately, which is, there's nothing normal about it. There was nothing normal about Ukraine war. Now there's nothing normal about this war, but it is happening. And to put it mildly, things I don't think are going according to what the initial plans were laid for the war. Anyways, if you had my indicators, if you were trading oil, then you had 2 days to get in here, March 2nd, March 3rd. You could have gotten in at around $74. Oil spiked to, as high as like 120 or so. This is American oil, light crude oil futures, CL1 explanation point. Now, even at this elevated prices, notice that we were getting continuous buy signals. How do we know we're getting continuous buy signals? Is this, we are simply looking for a price to drop below the blue support resistance line. Like for example, here on 9th of March, price spiked way into stratosphere, dropped below the blue support resistance line on March 10th, and this means we are like, get ready. They call it arming. And then 2 days later we have a trigger event right there, 12th of March, so close above the blue support resistance line. Now your target is somewhere around the green line, so your target was just reached if you were trading it just recently. So you could have gotten it around 95, 97, and you're now at around 111. Very easy to trade with my indicators. We can look on the weekly chart, and we will see the same general principle. Also remind me to show you the short-term chart as well. Okay, so here is the weekly time frame, longer-term time frame. And on this chart, basically what I want you to look at is this March 2022 high. This is a Russian invasion of Ukraine. We're currently trading as high as 113, 111, 113. Back then the price went as high as 130. Now remember that Russia produced at that time something like 10% of world oil, and now it's even less. And I think now it's even less because literally like this 2 weeks or so ago, or last week, Ukrainians burned like a major port in the Baltic Sea that was oil terminal. So not sure where the oil exports for Russia are heading, but the way things are going, I think that we will at least challenge this high from last week or whatever, 2 weeks ago, from 9th of March. And that high is around 120. I am fairly certain we will at least challenge that chart. And then most likely if we get there and break higher, then we will challenge the March 2022 highs. And I don't know if this is the end of it. We can also look on it from a perspective of, let's just say that we do break out. Let's say we are now above this, 130 line or so. So that I want to draw out for you the pattern that I'm referring to. So basically something like that. Okay, so that's the depth of this pattern. And the depth of this pattern is $67. So a very, very terrible prediction would be something like this, where we are duplicating the depth of this pattern on the upside, which would imply oil at around $200. Can that be reasonable? Can we see a $200 oil? Unfortunately, yes. And $200 oil would be, well, catastrophic for some places, very, very bad for others. Unless we learn somewhat quickly to somehow conserve, use less oil or something of that nature. Anyways, I wish I could bring you good news, but very briefly, let's look at the 4-hour chart. I forgot to mention it at the beginning. So a 4-hour chart is firmly in a downtrend. Notice this downward facing arrow. So every time we come up to the red line and then close below it, we sell short again, Come up to the red line, close below it, sell short. Come up to the red line, sell short, etc. So this has been working quite well since beginning of war, basically, with Iran. And now we're seeing again several sell signals. Latest one of them on Friday. So what happens Monday? Well, again, this is very difficult to say, but I'm almost guaranteeing you that the price will gap. It will either gap up or gap down somewhere, because this is a long weekend in America, at least. This is Good Friday, so there's no trading, and so the pent-up orders will be released on Sunday night, but then even more on Monday morning, and most likely there will be a gap. Which way the gap will be, the latest bias is to the downside, so we could easily gap down and possibly even continue lower and take out these lows. Now, I also promised to show you why I think we are approaching a level where a rally becoming more and more likely. So this is a put to call ratio. So puts on top divided by calls on the bottom. Puts divided by calls. How many puts are during the day? So puts are bearish bets on S&P 500 going down. Calls are bullish bets S&P 500 going up. And notice what happens right now. We're actually very highly in favor of puts. So when there are so many puts, the rally becomes more and more likely. As in, for example, right there, back in April of 2025, when everybody thought the market will go to zero, actually we got the opposite. So we had way too many puts, too many bears in the room, cause the opposite. So we're kind of getting to that level. We're very, very much in favor of puts right now. And all we're waiting for truly is for the S&P 500 to become what I describe as oversold. So right this instant, we're not yet oversold. We're still waiting for this blue line to be hit. All right, let me know what you're thinking. Again, don't forget to make a comment. Once you make a comment, once you put thumbs up on the video, come over to MasterChartsTrading.com. Click on sign up for one of the packages. So again, trading indicators are these lines on the chart. You can trade pretty much everything under the sun on most time frames. Like for example, this one is a 4-hour chart. It's a 4-hour chart, but you can trade on 5-minute charts as well. You can be buying them as well. You just need to have a, for example, futures account or something of that nature. Or you can trade Forex as well if you're into that. So those are the indicators. They're available for TradingView.com. This interface is called TradingView.com. It's free. You can get a free TradingView account. So once you sign up for a free TradingView account, come over back to my site, Master Charts Trading, sign up for the indicators, and then I will open the door for you on TradingView.com so you can see the same charts, same lines. You see? Newsletter, I send out daily alerts about various securities we trade, and weekly members only video. This week's there's going to be quite a busy video because we have a lot of stocks that are oversold. However, again, it is a question of do we want to be buying them or do we want to do nothing. My kind of bias is to do as little as possible right now until we see some sort of clarity. Best deal is to get both trading indicators and newsletters. Best deal of those is to get either a yearly subscription. The best deal is to get the yearly subscription because you get 2 months off, which is 17% off monthly price. And of course, you get a free 7-day trial, so you can cancel and find out if the service is for you or not. Again, don't forget to hit the like button, make a comment, share this video. Thank you for watching. Have another great trading week. Bye-bye.